Dollar cost averaging versus lump sum investing. It's a huge debate among investors, and I'm here to give my take and what I think is the best. Before I do, if you're new to my channel, be sure to subscribe. I'm somebody that's transparent. I provide quality, regular content, so I'm not just gonna disappear someday. And I wanna become wealthy. I wanna grow my knowledge, and I feel that we can all do that together on this channel, so be sure to subscribe. Now let's get started. Let's talk about first dollar cost averaging. This is where you invest equal amounts of money on a set schedule. So I put together this example where let's say you have $5,000 and you choose to invest it over 1 year, and you invest it 5 times over that 1 year, so every few months. Well, we're gonna buy one stock every few months. So let's say we buy the first share at $1,000. The market does a little better, so we buy the second share at $1,100. But then the market goes down some, and the third share we buy at $925. And then the market goes down even more, and we buy the fourth share at $900. But then we see a huge uptick towards the end of the year, and we are able to buy our fifth share at $1,050. So what that does is that gives us an average cost per share of $995. Now, if we were to put all that money in the beginning and buy 5 shares at $1,000, that would be our average cost per share, $1,000. Now that is technically lump sum investing, where you put a large sum of money in all at once. And as we can see in this example, dollar cost averaging beat lump sum investing by $5 per share. That's how much you saved by dollar cost averaging. And that's because you took advantage of the dip. It's that simple. So again, lump sum investing is investing a large sum of money all at one time. And as we continue with this debate of lump sum investing versus dollar cost averaging investing, let's see when it's best to do either or. So this one's easy with, during a bull market, lump sum investing is gonna be best because you're gonna put your money in here and it's just gonna go up as the stock market goes up. Where a bear market, it's better to do dollar cost averaging because you're gonna put your money in up here, and as the market goes down, you're gonna average down with it. So I looked at I actually looked at quite a lot of studies out there on what's best, and to my surprise, the majority of the studies said that lump sum investing is better than dollar cost averaging. And a specific example that I looked at said that lump sum investing outperformed dollar cost averaging by 75% of the time for stocks and 90% of the time for bonds. So I thought about this and I put in some common sense. I was like, well, it kind of makes sense because usually the stock market over time goes up. We have way more green days than we do red days. So I think that does reflect and mirror the results there, where lump sum investing does win most of the time. They even took it further to say that lump sum investing plus rebalancing your portfolio, so selling those stocks that have outperformed and reallocating them to stocks that are underperforming, and doing that regularly is the best result. But does that mean that we should all do lump sum investing? Well, first of all, myself included, and probably the majority of you, we don't have the money to do lump sum investing, right? We don't have $1 million that we just inherited to lump sum invest. So that kind of puts us right to dollar cost averaging as our only option. But not only that, there are 2 other things that are important with lump sum investing. Your risk tolerance, because it is more risky, and your time horizon. Because if the stock market or a stock or a certain ETF goes down for years and years, if you're closer to retirement, if you do a lump sum investment, that's not gonna be good because you're gonna be in the red. So I thought it would be best to look at a perspective from a famous investor, and that is a guy by the name of Jack Bogle. He is a very famous American investor. Unfortunately, he did pass away in 2019, but he was a businessman, an investor, philanthropist, and most importantly for us, which I think is very interesting, is he was the founder and chief executive of the Vanguard Group. And he was credited with creating the first index fund, something that we all probably utilize, and it's been a very big benefit to many, many investors. So I wanted to show this video of his thoughts on dollar cost averaging versus lump sum investing, and let's take a look.
Dollar cost averaging is, in one sense, not a particularly productive idea. And that is to say, if you've got, say you come into $1 million from your nice deceased aunt, and decide you will average into the dollars, you'll probably do better most of the time. Nothing is universal if you invest it all in the same day. That's the plus, because the longer you hold a stock, the better it tends to do. The big minus is that you might have picked basically the day that I was born to start investing in May of 1929, and in which case the $1 million goes to 100,000 by 1933. So dollar averaging is a good way, if you have a lump sum to invest, to make sure you're going to do some kind of, like, spread it out over 4 years, do it every quarter, something like that, 5 years, and that's a conservative idea.
As we can see, he pointed out that dollar cost averaging is not a productive idea. He said that lump sum investing is probably better because the longer you hold a stock, the better it tends to do. And we can look at many examples of where that is the case. The majority of stocks are going to go up. There's obviously going to be some losers out there, but more so winners. He said, but the big minus, I want to highlight that, the big minus is that there's a lot of risk with that, because you could have invested on the day that he was born in May of 1929, and you could have did a lump sum investment there. And if you put, let's say, $1 million in 1929, that could have gone down by 1933 to $100,000. Now, I went back to look at the charts in the 20s and 30s and 40s and even 50s, and to my surprise, in 1929, we see here that we had the Roaring '20s followed by the Great Depression, and it took until 1954, if you were to put all your money in 1929, to be back in the green. That is 25 years later. You would have had 25 years of being in the red if you did a lump sum investing in 1929. So that's the example he gives. It is high risk. Another interesting thing is that I read that the Dow Jones back then was more like the NASDAQ is today, in that it is heavily in the growth sectors. So maybe that's something that we should all look at closely. Hopefully history does not repeat itself there. But basically, we can't predict crashes, right? Who could have predicted 9/11 and many of the other crashes? Nobody really can. There's a few that get lucky. But let's look at some real life stock examples. So if we look at Apple, this is a stock where it would be best to do lump sum investing, because if we invested in, let's say, 2012, and by 2022, 10 years later, we would be up 911%. So that is an example where lump sum investing is great. Even further, if we look at the S&P 500 from a similar timeline from 2012 to 2022, if we did lump sum investing in 2012, we'd be up 292% right now. So these are examples where lump sum investing is good. But there are some downfalls. We can see with AT&T, this is where dollar cost averaging is best, because if you invested in the year 2000, you'd be down almost 56% by the year 2010, where if you averaged in, it'd be a lot less than that. Not only that, if we look at the S&P 500 from 2000 to 2010, if you lump sum invested in the year 2000, you'd be down 27%. These are all 10-year time frames, which are pretty long time frames. So I basically just wanted to put this in perspective on the risks with lump sum investing, also the benefits of it. I also want to show this chart. I've showed it before. It's one that I really like to show because it shows that the recessions down there in red, those little short recessions, are followed by powerful expansions, the ones in purple. So an expansion lasts on average 67 months and is up 24%, where a recession lasts on average 11 months and is down about 1.8%. So again, lump sum investing outperforms because the majority of the time we're going to be in powerful expansion times, but you have to time it right, I feel, to really make those big profits. And it looks like we're possibly in a recession or going into one in now. So this could be a great time to do lump sum investing if you have that opportunity. So, you know, my summary of this is there's no right or wrong answer, right? Everyone's situation is different. Everyone is going to invest into different things. But for the majority of us, I think that our risk tolerances are pretty low and we don't want to be risky with our hard-earned money. So I do think that dollar cost averaging would be best for most of us. Now, if you do decide to do lump sum investing, I believe it's best to diversify when you do that. So put it in a few different stocks, ETFs, and maybe bonds. And that way you're kind of protected, but also make sure you have a long-term time frame, a time horizon, because if you're closer to retirement, I think that's too much risk. But if you're in your 20s and 30s, I think lump sum investing in a diverse way is probably going to create a big win for you. And that's just my opinion. So dollar cost averaging, definitely the safer way, and I think for the majority of investors. But if you have the money and you're in your 20s and 30s and you diversify it, I think lump sum investing is what you should do. So that's my opinion, but either way, you win because both paths create wealth if you do it in quality companies, ETF stocks, and you diversify, you should do just fine. So this is my opinion on dollar cost averaging versus lump sum investing. I'd love to hear what you think. Which one do you think is best? Do you think one should be avoided? Or do you think people, I do know that dollar cost averaging is really touted heavily out there on YouTube and other platforms, and we don't hear of lump sum investing much, but do you think one is better than the other and why? I'd love to hear your opinion. So with that said, thank you for joining me today, and we'll see you next time on Mark Arnold's Finance.